Hi, I'm Andrew Radkiewicz. I'm the Global Head of Private Debt Strategy here at PGIM Real Estate. I think it's probably less a question of landscape changing, but landscape actually now seeing in real terms the impact of higher interest rates, DSCRs coming under pressure, having an impact on actual loan proceeds from lenders. Obviously, what we've had a bit more of is a realization of value changes, value drops. It's been a bit slow to filter through to the market, but the V of the LTV clearly is coming down as well. So if anything, it's becoming more realistic now in the market that traditional lenders, if they are lending, are lending at much lower levels of loan to value, with particular and also applying stress factors to the values themselves. I think the challenge, if we first look at where the finance is available, and then and almost say everything else is a challenge, but if the finance is still available and we're seeing finance all coalesce around high quality transactions, low leverage, quality sponsors, and so there is finance available and actually reasonably competitive for what I'd call very high quality investment grade equivalent transactions. They still work for most lenders, and I think we still see some activity still there. And broadly, once we go beyond that spectre, the life becomes challenging in terms of finding real estate financing. I think you can look at a number of big challenges, but I guess one big one we can talk about is the wall of maturities that everyone keeps on bringing up. From our perspective, I mean, if you think, there's an interesting statistic that's grown that in the UK, over 60% of all commercial real estate loans are expiring in the next 3 years, which sort of brings the statistic. That number was just over 40% just a few years ago. So it's the growth in that, obviously COVID, and obviously the inability to refinance maturities. So for us, we perhaps don't look at that too much as an opportunity yet because of the loan books, but because the traditional lenders will be stuck with this for quite a while, we still do see it as a restrictor on future liquidity for new financings going forward. So that's probably one large challenge. And I think if you look at it, if we look through to the real estate acquisitions market, the equity markets, they're very, very slow and very low. So in terms of financing for new acquisitions, that is muted. So a lot of the activity or people looking for capital are looking for capital to refinance existing loans. I think there a lot, as I described with this refinancing and the answer to the first question about the stresses on loan to value and debt service, in the mainstream of those are still a bit log-jammed in terms of finding homes for what I'd call traditional loans, even at high loan to values. However, there is some interest around the edges. For example, particularly in Europe, particularly once one starts looking at sustainability and ESG and occupier demand and investor demand, that there are brand new properties that have just been built that need construction finance refinance. So they have a situation where you have a brand new property. It needs a period to stabilize its income before it can bring in new capital, but there's a gap of financing certainly there. And another one, similar fact, that there is an argument to be said that actually development finance is a very interesting place to be. As risk has shifted away from the day-to-day loan servicing to maturity and exit, then if you look at what type of asset a lender would like to be secured again in 3 or 5 years' time, obviously grade A, brand new, net zero are all interesting things to bear in mind. So although in the mainstream seems to be a bit logjammed, around the edges there is some activity beginning to come out. Yeah, I touched on sustainability and ESG, and I think that does fit firmly within the opportunities. Here at PGIM, we have actually for a few years now followed some structural themes in terms of the real estate market, and we sort of capture them with what we call our 3Ds: digitalization, which is the impact on the real estate markets, not just of e-commerce, but supply chain and changing trends with real estate, particularly in retail and other things. So that covers obviously everything from logistics to perhaps things like cold storage all the way through to data centers. So that's definitively been a focus of ours in recent years. Next one is multi-generational demographics, fit for purpose rental markets in Europe, everything from student through to co-living, traditional build to rent, all the way through to senior living and different generations there. So that's something we've been focused on. The third one that's really, I think, come up to the top, if you like, is decarbonization. And as the market is obviously experiencing stresses, when you look through what tenants and occupiers are demanding, and also what the investment community in real estate is demanding, it is very clear that that needs to focus on energy efficiency and needs to focus on fit for purpose, ESG compliant real estate. And we see that not only as a challenge, but a significant opportunity because there right now, only about 15 to 17% of the whole real estate market in Europe is energy compliant with upcoming legislation. So there's a lot of work to be done. And so the opportunities we see there are, for example, you could describe green loans, which are effectively loans that finance new developments, with those developments satisfying a lot of either EU taxonomy, but at least primary energy demand requirements. And on the other side, we've got sustainability linked loans, which is a sort of brown to green type of financing strategy, which in normal language is value add lending. However, with a focus that the end point needs to bring a property into a much more comfortable place where occupiers and investors are seeing what credentials they have through an ESG lens. So that's more sort of value add and development lending, which we see growing. And clearly, when you say things like development finance and value add, it's not without its risks. But we'd argue that taking near-term real estate risk and marrying that up, obviously you've had to have been doing it for a while, and mitigating longer-term maturity risk, market risk, is something you need to look at carefully, particularly with something as massive as the ESG and sustainability on the horizon. Definitively, if we look at, there's a lot of opportunity out there in the market. We don't believe there's any harm in narrowing and actually committing to what we believe within those structural trends. So, and it's different around the world. So the opportunities are a bit different in the US and Australia as well as here. We're active in all those markets. But I'd say sort of going back, if you really look regionally, and actually our research shows that it's not even regional by country, it's regional by city. So when you look at the different core asset classes, if you broadly look at industrial, you look at logistics supply on one end, you know, different countries are catching up. So we see interesting activity in Italy and Spain that needs to build a hell of a lot more logistics. All the way to Germany, there's still demand and going on. And there's some left in UK, but for example, UK's probably been at it for the longest. So opportunities against that new fit for purpose logistics differs across countries. Then coming to urban logistics, big question mark around that, lots of challenges, a lot of interest, really interesting area in terms of last mile. Sometimes that's repurposing retail parks for fulfillment centers, others is construction. So again, urban logistics in that area is quite interesting as particular asset classes. And then other things, for example, longer term trends around supply chain nearshoring. So cold storage is a great example. operating business, quite complicated to understand. However, if you look at the fundamentals of demand and inflation proofing and cash flow cover, super interesting. But you got to get up climb up a big understanding tree to do things like that. But I think that then leads into more and more operational style businesses. Ironically, we like them because that's where we add alpha. We are higher yield strategies as well as core. So we like operational businesses with the right operators because then you're co-aligned. Your income's much more granular. So now we move into, for example, living. Brand new fit for purpose student in the big university cities, focused around foreign students where we see a massive growth. That's been working very, very well for us, but mainly with developer operators where everyone's sort of co-aligned with that. Right at the other end, we like the sort of transfer between student through to normal private rented. We may feel that in lots of parts of Europe, the private rented sector has been focused maybe at a too high income part of the population. So that space in what we call affordable, but let's say more workforce, co-living as an alternative for students coming out, hybrid. That whole area is very interesting, again, with the right people, and that's where we'd be looking. All the way across to, again, more operational around new or nearly new care homes, senior living communities, where actually some operators from the US are bringing over some very interesting ideas of what senior living should look like in Europe. Absolutely, and obviously we've read a lot about the rise of real estate debt as an interesting asset class for investors. Again, not all real estate debt's the same, so you could probably put it into three buckets, like real estate, core plus value add, if you like. We'd call it core, and core in us is real zero loss underwriting. So this is investment grade equivalent, private debt. It probably caps around 50% loan to value today with a decent amount of debt service cover. So really solid sleep at night stuff that's really, from an investor perspective, is an alternative to fixed income, to alternative for bonds, or a private alternative. At the other end of the barbell, if you like, we call high yield, and that's where your development value add financing would fit in. That's where sort of the higher real estate risk today, higher returns type of lending, which generally attracts an alternative to real estate investors. So real estate investors will now look at high yield and go, over the next 3 to 5 years, it is difficult to argue that the equity markets and the debt market, or it's difficult to argue that an investor shouldn't at least look at the debt markets to see what sort of lower volatility income-based return you can get. So there you're sort of speaking to the real estate community. But there's a big community in the middle. I think this has probably been the biggest change in the market over the last couple of years. It's where real estate debt is now increasingly featuring within the private credit universe. So if private credit is dominated by direct lending and middle market and sponsored private credit lending, it's now bringing in on the one side real estate debt and on the other side infrastructure debt. And that opens up that community of investors in the middle, sort of looking for returns in between those two, but also quite open to multi-credit strategies as well. So I think as the investor community evolves, I think real estate debt across the board is seen as a really interesting asset class now, certainly more mainstream than it was in the last downturn in 2009, 2010, when we first set up and people didn't know what we were talking about. I think now everyone's doing it, so it's more mainstream. But that does come with a much bigger opportunity as investors are looking at the asset class for diversification, but also understanding it much more as a mainstream opportunity.